Hi, everyone. How is it going out there? Full disclosure, I am recording this video right off the heels of the Wednesday Fed announcement. Now, if you're not living under a rock, it's been the hot topic that everyone's been discussing, writing articles about, LinkedIn posts, whatever it is. So it is official. The Fed just came out that they're going to increase the Fed funds rate another 75 basis points. However, I think the biggest piece that is coming out of this meeting is that they expect the Fed funds rate to go slightly above 3% by the end of the year. Now, just to give you some context, the Fed funds rate has been between 0 and 0.25% for quite some time. So going from there to 3% within a year time span is pretty big shocking news. So what I want to talk about today is just the general idea of what does it mean? What is happening? Why does the Fed increase the Fed funds rate? What is the Fed funds rate? All that stuff. I know myself, I'm not an economist and I don't know everything about it, but I'm sure there's people out there that are also a little confused. So hopefully, the takeaway from this video is you just have a better understanding on what that actually means. So the general premise is that the Fed funds rate is basically the interest rate that banks are able to lend to one another. Now, historically, it's been very, very low, like I mentioned, 0 to 0.25%. Anytime the Fed comes out and says they're going to raise it, what that does is that just increases the interest rate, obviously, that the banks can lend to one another. But what they do is they pass that off onto the consumers. Now, right now, again, if you're not living under a rock, you know that inflation has been increasing and increasing for quite some time since the end of last year. The initial idea a few months ago was that this was the peak, it wasn't going to increase anymore, and it was actually going to start coming down. Well, that hasn't been the case. So what the Fed has access to is their intention. Again, now I'm not an expert, not an economist, but their intention is that they're increasing the Fed funds rate to make it more expensive to borrow, so that transfers down into everyday consumers like you and I, essentially decreasing the spending power and decreasing their want to go out there and spend money, which that decrease in demand essentially should decrease the cost of everything going on, the cost to go to the grocery store, the cost of gas, the cost of all this stuff. When that goes down, inflation starts to come down. So the general premise is that they're increasing the Fed's fund rate to combat inflation. Now, there's a ton of speculation out there that it's too late or they didn't increase it enough or whatever it is. And everyone can debate that amongst themselves, but that's just the general idea of it. To us, though, how does that impact the mortgage industry? Well, to be honest, that increase in 75 basis points, it's not like the rates are going to, tomorrow they're going to increase by 75 basis points. Actually, that increase, has been speculated for quite some time from the Fed. So the market has kind of baked that in already. So you shouldn't see too much of an instant drastic shift. But again, we all know operating within this market, things can change on the daily, almost on the hour. So, but that's just a general understanding. Now, going back to, again, what this means for all of us, it really shouldn't matter, right? It really shouldn't matter how much the Fed increased the rate. It really shouldn't matter if interest rates are now going to go to from 6% to 6.5%, maybe in the 7%, maybe in the 8%, maybe in the 9%. Who knows? That really shouldn't change anything with what you and I are doing. And I'm speaking directly to salespeople within the mortgage industry, whether it's loan officers, account executives like myself, broker shops, mortgage lenders, whatever it is. This has been going on for quite some time, right? For at least 6 months now where the interest rates have been rising. It's no surprise that everyone, you, companies, myself, we should all be focused on the purchase market, which again comes with its own baggage. There's no question there. But again, these are all external factors. The interest rates, the Fed funds rate, the low inventory, decreased buying demand, all that stuff, that is all very, very real and it's all reality, but it's nothing that you and I can control. There's a bunch of old school people out there. And when I say old school, people that have been around for decades. So they've operated within environments that have gone through recessions, that have seen extremely volatile interest rate markets and things like that. And I came across some information. I was reading an article, and there was one of those old school guys, and they provided some advice and some information. And I think it's extremely valuable, especially right now with all the news and the information that's coming out. It's extremely valuable to really look at, read, digest, and really look internally and see, just make sure that you are still operating in a way that's going to deliver value to your clients. So the first thing is, don't let this market define you, right? It's very easy to slip into a mindset of like, oh, well, let's pack it in the rest of this year, right? This year's over. 2023, 2024, I'm going to look towards that. Don't let this current market define you. In fact, use what's going on to define what your market is, right? So come up with new strategies, come up with new talking points with your clients, right? Maybe it's not specifically about interest rates now. Maybe you're just out there to give your clients, an everyday person, more information on exactly what is going on in the market. The second thing is, when markets get hard, specifically our market, people tend to quit. People tend to give up. Now, when people do that, that's great for you and I. You know, the people are going to stick in this market because, number one, that's less competition, right? So that's less people that we have to compete with. And if you can find positivity and value in what you're doing, it's going to attract the right people. And then number three, I mean, people are still going to buy, right? Regardless of what interest rates are, people are still going to buy, people are still going to sell. Now, mind you, not at the same rate that they have been doing, but there's still going to be business out there. So what you need to do is you need to be the right solution for those people looking to obtain business from you. And how do you do that? You know, first things first, deliver value to them, right? Hopefully you're finding value in the information I'm delivering to you. Do that to your clients, right? If they're stuck on the interest rates right now, explain to them why the interest rates are what they are, and explain to them what just happened today, and just give them all the information and let them come up with a decision. And if they end up using you, great. If not, at least you gave them value and they can walk away feeling a little bit more knowledgeable about the situation. And then lastly, stop. And again, I'm talking to all of you salespeople in the industry right now. I've had countless conversations over the past few months. Stop feeling bad for yourself, right? Stop having this victim mindset, like this is happening to me, right? This interest rate market, rise in interest rates, this is all happening to me. There are times to feel bad for yourself, but now is not one of them, right? Now is the time to actually dig in, more now than ever, to dig in, focus on what you're good at, focus on delivering value to your clients. And if you stick with it and you stick it out, I'm very, very confident you're going to come out on the other side and you're going to be better for it. Hope this helps. Hope everyone has a great rest of your day.